3.3%. That's where inflation stands after the Bureau of Labor Statistics released the March CPI report. It's the highest in 2 years and the hottest single-month jump in 4. And gasoline rose 21% in a single month.
Inflation rose to 3.3% in March, the hottest reading in 2 years. Another number that came in this week, which is that the Q4 GDP number was revised down to 0.5%. Reuters reported yesterday that U.S. economic growth has slowed more than previously estimated. In the fourth quarter, downgrades to business investments and inventory accumulation, but corporate profits increased sharply, according to government data. Are these two things connected?
Well, they are, but it's an inflation story. And, the President of the United States ran on this idea that he was going to lower inflation in the United States. And between the war and tariffs, we are not there.
But the scariest part isn't the numbers that we already have. It's what these numbers mean for all of us going forward. I'm Max from UNFTR for the MeidasTouch Network. Let's get into it. All right, let's go back. When Joe Biden took office in January of 2021, the post-COVID inflation wave was just beginning. So by June of 2022, CPI had surged to 9.1%. That's the highest reading since November of 1981. It's a 40-year high. The Fed, under Jerome Powell, responded with the most aggressive rate hiking cycle in a generation, taking rates from near zero all the way to 5.25%. Now, there's a camp out there that claims that this medicine worked, a mild nod to the Volcker strategy of yesteryear that we'll talk about later. Others say that the COVID inflation spike was the result of corporate greed and supply chain shocks, and therefore uncorrelated from traditional forces of supply and demand, and therefore the interest rate hike was kind of beside the point. I personally fall into the latter camp for what it's worth. Now, regardless of the mechanisms that ultimately drove down inflation, by January of 2023, it had fallen from 9.1 to 6.4%. By September of 2024, it was at 2.4%. That's nearly a 7-point decline in just over 2 years without triggering a technical recession. Now, once again, to play the contrarian, I personally believe that more than half of the country has been in a persistent recession since 2008. But again, I digress. So on the top line, at least, the labor market held, and the Fed had achieved its so-called soft landing. Now, to be balanced, in the final months of Biden's term, that's October through December of 2024, inflation did tick back up from 2.4 to 2.9%. And we have to call balls and strikes on the left, unlike how the right likes to retcon data. So what we saw is that shelter costs were sticky. Food prices had firmed by that point. And crucially, the markets were pricing in a tariff risk that came with the November election results. Remember, Donald Trump was promising to implement tariffs across the board. I just don't think that anybody thought it was going to be as extreme as it was. So even at 2.9%, we were still somewhat in the range where the Fed had some credibility and some options if you're inclined to believe that the Fed alone has the ability to move the needle on inflation. And then Trump's second term started in January, and the trajectory began to change. Now, again, to be fair, between January and April, inflation resumed its cooling period to a low of 2.3%. It's before the Liberation Day own goal. But by June, it was back at 2.7. By September, 3. And now, as of March of 2026, it's 3.3%. That's a full percentage point in just a year, which also blows apart the theory that inflation was transitory. And oh, by the way, this is during a pretty depressed period if you're looking at the bulk of American incomes and whether or not we are still technically in a recession. So we need to talk about the nature of the inflation data because it's different from what we dealt with under Biden, and the way forward has also fundamentally changed as a result. So to do that, let's again take a step back and talk about how inflation is actually measured. So essentially, there are two major inflation gauges. One is CPI, or the Consumer Price Index, and that's usually the one that you hear about. This one measures prices from the consumer's perspective, and it's released every month by the Bureau of Labor Statistics. Then there's PCE, or the Personal Consumption Expenditures Index, which is the Fed's preferred measure. Now, PCE is released by the Bureau of Economic Analysis, and February's reading came in at 2.8% headline, 3% core. Now, here's the key difference and why this matters. When you hear the term core inflation, whether it's core CPI or PCE, that means that they've stripped out food and energy prices. And the reason that economists prefer to look at core is that food and fuel are historically volatile. They spike and then they retreat, so they're kind of noisy. So to get a read on the underlying trend, you just take them out. Now, here's the problem with that logic in this environment. When energy prices are volatile, stripping them out does give you a cleaner read. When energy prices are structurally elevated, stripping them out is a fantasy. And we covered this in detail in a recent video on oil and gas. The Strait of Hormuz has been effectively closed for several weeks, so global oil inventories are on track to hit historic lows by the end of May. The infrastructure in the Persian Gulf has also been damaged, so the strategic petroleum reserves are being drawn down to the point of functional depletion, and we're losing our backup scenarios. And even in a best-case scenario, a full reopening of the strait, the ceasefire holds, tankers resume, the permanent price floor for crude has been reset upward by at least $20 a barrel. So that's what I mean by structural. This isn't just volatility or supply and demand issues or anything related to market fluctuations. This is a structural change to the floor of the price of oil. So when fuel doesn't fluctuate back down anymore, when oil at $100 becomes the new floor and the new baseline, stripping energy from your inflation calculation doesn't reveal the underlying trend. It just hides the new reality. So the CPI tells you exactly that. The headline CPI, 3.3%, core, 2.6%. And the delta between those two numbers is almost entirely energy. So gasoline rose 21% in a single month, accounting for about 75% of the total headline increase. And if you only looked at core, you'd think that things were fine. But they're not fine, and this is where it gets real. When crude oil prices spike, the first thing you notice is the price at the pump, because gasoline responds almost immediately, actually within days, which I found pretty amazing because I thought it would take a couple of weeks. This time it happened almost instantaneously. So that part almost everybody feels, but that's only the beginning. Energy costs flow into everything. Every product that's manufactured uses energy. Every product that's shipped, whether it's by truck or rail, container ship, doesn't matter. They use diesel. Every piece of food that's grown requires fertilizer, which is petroleum-based. Every warehouse, every cold chain, every factory floor, everything is affected. Now, the San Francisco Fed just published a study in late March showing how tariff-driven inflation works through the economy over time. So what happens is goods inflation peaks in year 2. That's where we are right now. Services inflation, the stickier, harder to reverse component, peaks in years 3 and 4. So we're entering the window right now where the tariffs that went into effect just about this time last year begin showing up in earnest. So average U.S. tariff rates went from under 2% to nearly 17%. And those price increases are now compounding on top of an energy shock. And the February PCE data already shows this. Goods prices essentially went from flat in December to plus 1.2% by February. This is before the war, right? Services hit 3%. That's the highest since January of 2025. Now, these are leading indicators, and they're all moving in the wrong direction. Airlines, shipping companies, manufacturers, food distributors, none of them are absorbing these costs. They're beginning to truly pass them on. And the consumer, which is you and I, we're at the end of that line. So what does the Fed do? Here's the honest answer. Again, my opinion. Not much. The Fed rates held at 3.5% to 3.7% at the March meeting, and it was an 11-1 vote, with, of course, Stephen Myron being the only dissenter. Only one cut is projected for the rest of 2026, and 7 of 19 members now see 0 cuts this year. The bond market has essentially priced in that the Fed is frozen, and this is the part that I want you to really sit with because it explains why this is different than anything that we faced under Biden. See, under Biden, the Fed had somewhat of a legitimate playbook, although, again, I tend to downplay the effectiveness of it compared to most people. But the reality was inflation was high, and it was driven by a combination of corporate greed, pent-up demand, and costs related to supply chain snarls. So to the extent that corporations slowed price increases and the Fed tamped down on demand by increasing rates, you can make a case that it was partially responsible for augmented disinflation. And even if we're being charitable in terms of the Fed's effectiveness, the nature of this crisis right now is entirely different, because what we have now is a supply-driven inflation. So energy costs are elevated because of a physical disruption to global oil supply. Goods are elevated because of tariffs. And the Fed can't drill for oil, and the Fed can't lower tariffs. So raising interest rates doesn't create more tankers in the Strait of Hormuz, for example. Now, the Fed does have a rate hammer, but this is not a nail issue. So the only scenario where the Fed's traditional tools become relevant is the so-called Volcker scenario. And if you're not familiar with it, since I alluded to it before, in 1979, then Fed Chair Paul Volcker took the federal funds rate to 20%. As a result, mortgage rates hit 18.6%. Unemployment peaked at 10%. That was the worst since the Great Depression. So things like crazy stuff happened, like home builders mailed 2x4s to the Fed in protest, and car dealers sent coffins filled with car keys. It was mayhem. Congress threatened to impeach him. Now, there are several camps to this that sit along a spectrum of that was completely unnecessary all the way to he did the hard thing and it really, really worked. But no matter your interpretation of that period, he ultimately did succeed in destroying demand. It's the monetary equivalent of chemotherapy. No one really wants it, but if inflation becomes embedded, if it gets into expectations and into contracts and into behavior, the Fed may once again dredge up this playbook, and then all hell will truly break loose. Now, it doesn't mean the Fed is powerless, because in the meantime, what the Fed can do is maintain liquidity in the banking system. They can, take care of their own. They can backstop credit markets. They can keep the plumbing of the financial system working. But they can't fix a supply-side energy crisis compounded by self-inflicted tariff damage. And this is where I want to bring the lens down from the macro to our kitchen tables. Because the pain of inflation isn't equally distributed. At the very top of the wealth spectrum, the top 1%, top tenth of a percent, inflation to them is an inconvenience, but it's not an existential threat because their wealth is in assets that appreciate: equities, real estate, private capital, and so on. Under Trump's tax regime, their gains have been enormous, and they also have been compounding. So since 1979, the top 1% has seen wage growth of 182%, but the bottom 90% has only seen 44%. That's over the same time period. So they can weather a storm like this, but for everyone else, inflation is the single most destructive economic force in daily life. It destroys household savings. If your savings account earns 2% and inflation is running at 3.3%, your money is losing value every single day. It kills business cycles. Small businesses that run on thin margins can't absorb rising input costs, and so they cut staff or they close down. And layoffs lead to more layoffs, which leads to falling demand, which leads to a recession. So that's the inflation doom loop. See, inflation is the one metric where the average person and economists agree. It's the most feared number in the economy because unlike unemployment, which is targeted, inflation is indiscriminate. It hits everyone who buys food or fills a gas tank or even pays rent. So where does that leave us? Economically, there's nowhere to hide in the short term. That's the really, really bad news because this is an entirely manufactured crisis. The war in Iran is a choice. The tariffs were also a choice. But the combination of the two has embedded a stagflationary crisis, which is slowing growth and rising prices, and the Fed can't solve it with its existing toolkit. Only a massive demand destruction event brings oil prices back to pre-crisis levels. And as we discussed in our last piece, demand destruction is a recession wearing the mask of a market correction. But, and this is important, there is an opportunity here, a political opportunity. It's potentially historic. Because the last time we entered a crisis like this, like real stagflation that was energy-driven with a deeply unequal economy underneath it, was the 1970s. And that crisis literally changed the world because it discredited Keynesian economics, which did not have a playbook to handle that type of crisis. And it also ushered in the era of Milton Friedman and Ronald Reagan, Margaret Thatcher, deregulation, tax cuts for the wealthy. Basically, the 50-year neoliberal experiment that produced the greatest wealth concentration in modern history. The 1970s were the hinge point for all of it. Everything that followed, the financialization of the economy, the gutting of unions, the stagnation of middle-class wages, flowed from the policy response to that crisis. But now the tables have turned because they're in power and the pendulum might be swinging back. Donald Trump may have unwittingly created the conditions for a fundamental rethinking of economic policy if the Democrats have the courage to drive this lane. And in my mind, that's the biggest if that's in front of us. The neoliberal consensus was already beginning to crack because we had the 2008 bailouts, the COVID fiscal response, the bipartisan turn toward industrial policy. But it hasn't broken. It takes a crisis to break a paradigm. And this is it. The question is whether or not people in power are willing to articulate a different economic vision, not just warmed over austerity and a return to the norm, because the norm hasn't been working for most people. This is not a market will self-correct kind of thing, but a genuine public investment, a fair tax structure, an energy transition that reduces our dependence on a 21-mile choke point, and an economy that works for more than the people at the top. The door is wide open if we have the courage to walk through it. That's it for me. For the MeidasTouch Network, I'm Max from UNFTR. You can find me on YouTube and Blue Sky at UNFTR. And don't forget, sign up for our free weekly newsletter at UNFTR.com. Until then, I'll catch you online.
Want to stay plugged in? Become a subscriber to our Substack at MeidasPlus.com. You'll get daily recaps from Ron Filipkowski, ad-free episodes of our podcast, and more exclusive content only available at MeidasPlus.com.